Good morning, good afternoon, everybody. Thank you for joining us today for the next sort of 45 minutes to an hour with respect to going over the new tax cuts provisions with a focus on businesses today. I think, as you're most probably all aware, my name is Rob Whittall, but I'd also like to introduce Julie today, who some of you most probably have worked with already. So Julie and I will go through various provisions that we believe are going to have an impact on your business in 2018. From a participants perspective, we've got a good range of sort of clients that are in the UK coming to the US, or people who are in the US and doing business in the US. So we're going to try and cover the pertinent parts which we think would have an immediate impact on everybody. Just to remind everybody that our second part of this is going to be next Tuesday at the same time, focusing on individuals. And just to remind people that with respect to everything on the screen, there is a question button there. So if you have any questions as we go through, if you want to type them in there, we will try and address them at the end of the presentation. And any ones that we don't manage to get to, then we will follow up with afterwards. So without further ado, we will move on. So the things we want to cover today, in a sense, is sort of an overview of what the general perception is of the new tax act that came into play. We'll talk about how it's affect corporations, how it's affect partnerships, LLCs, talk about some of the depreciation and expense deductions which have changed. There's some expansion on what type of a method of accounting you can operate as a business, whether you're on accrual basis or cash basis taxpayer. There's various things that have sort of changed on compensation that will mostly affect quite a few people on the call, where you have employees in the UK and then you're moving them to the US or vice versa. And then we'll finish up talking about how the US system for taxation of foreign income at a business level has changed. So just as an overview, as I imagine everybody's aware, and I know it was on the news in the UK and stuff like that around about Christmas time, is that on December the 22nd of last year, President Trump signed in a big new tax law bill into law, which basically, as says here, was mostly the biggest overhaul of the Internal Revenue Code here, the statute, in more than 30 years. The last time when you talk to tax professionals over here, when there were so many changes, was the Tax Reform Act of 1986. But basically, in the idea of this new law, definitely at an individual level, which we'll talk about next week, is to try and hopefully simplify the system for the average taxpayer. And in reality, it's quite interesting because it's going towards more the line of what we have in the UK, where you sort of will have your taxable income and have one personal exemption, and that will be the majority of people. So the idea is for the majority of the people, their individual tax filings will be more straightforward. But I think everybody would agree that all the changes that have come into have been enacted from a business perspective, in reality necessarily haven't really simplified the business taxation of things in the US. The major things that have sort of come in, which we'll talk about some today and some next week, is reduction in tax rates at an individual and a business level. Certain deductions have been eliminated. Corporate alternative minimum tax we'll talk about has been eliminated. How partnerships, LLCs are being taxed there's been radical changes there, which Julie will get into. And then there's certain things that have come into effect from international tax that have basically changed how the US taxes foreign income of foreign corporations being repatriated to the US, and they're moving towards more of a territorial system, which is what we see in the UK already. So let's talk about corporation tax rates to start with. Is that the big change here is the fact that effective 1/1 of 2018, the US corporation tax rate has gone to a flat rate of 21%. Whereas I think all of you who are aware that previously the old rates were on a graduated system, from starting at 15%, going up to a highest marginal rate of 39%. But the questions come up is that what happens if you don't have an accounting year that ends directly on December 31st? How do you work out what your tax rate is for, say, a June 30th, 2018 year end? Well, what you have to do is you basically work out what your taxable income is and work out what the tax bill on that would have been under the old rate. And then you work out the tax on the year under the new rate, and then basically you take 50% off the one number and 50% of the other number, and that gives you your tax for the year. So it's going to be time apportioned for this period of overlap, which would be any accounting period that would end in 2000 and that would have started in 2017 but didn't end until 2018. So the big questions also come up is, well, okay, Rob, so are we better under the old system or the new system? Interesting enough, if you look at this table in front of you, that under the old system, you are actually most probably better off until you get up to about 85,000 in profit. And then from there onwards, you are better off under the new system, which is a sort of interesting because, as everybody will know, that in effect is with a lot of the businesses that we work with that are starting up in the US, we've always sort of been focused to try and make sure that we're sort of paying tax at the most efficient rate we can in the US to tie in with what you're paying in the UK. And obviously under the old rates, depending on what bracket you fell into, is the differential between the UK and the US rate varied depending on the level of profits. Whereas now the rate is going to be consistent all the way through. So at the US at a federal level, we're paying 21, and depending on if you pay a state rate or not, you could be paying maybe federal plus state 25, 26%. So there's still going to be a differential between the UK and the US rate. So I think good planning of where various income is recognized and management fees and appropriate cross-charging are still going to have a big play on how you, from a UK perspective, manage your global tax rate. In the US system, both for corporations and individuals, there was always a situation, a tax system within the US called alternative minimum tax. And basically what you did was you would work out your tax rate, your tax liability under what I call regular tax purposes, which is most probably those rates we talked about before. And then you would also work out your tax rate under alternative minimum tax. And the difference between the two is certain things were allowed for one, were not allowed for the other. And in effect is what you would do is you would calculate your tax under both systems, and whichever gave you your highest tax liability was the one that you paid. That two-tier system now has been eliminated effective for years beginning the first of the tax years beginning after the 31st of December of 17. I just need to change that on the sides. But the old law basically was 20% of the taxable income. Now, if you did end up paying alternative minimum tax as opposed to regular tax, when you finally got back into regular tax, any AMT that you had paid was always creditable against your current tax liability. So in effect is all you were doing was prepaying your regular tax, and when you got back into regular tax, you would get it refundable. So what they've said now is, because the rules are changing and effective alternative minimum tax doesn't exist now, is they're basically, if you've got an alternative minimum tax liability out there that isn't going to reverse by 2021, then in 2021, any balance that you have on account will be refunded to you. So in reality is alternative minimum tax has gone, and we only have to worry about one tax system now. So Julie, I'll let you carry on from here for a few slides.
Okay. Good morning, good afternoon, everyone. I guess the other big thing that's happened with this tax act is, you might have heard about, is the pass-through deduction. And before we jump into the pass-through deduction, I kind of wanted to discuss the domestic production activities deduction that has been around for a few years that many of our clients have taken great advantage of. And the reason we'll start there is because it's kind of being replaced with the new pass-through deductions. So,
but the old domestic production activities was really, it was a benefit that both corporations and individuals got for their pass-through entities that were in the business of basically manufacturing stuff and, in a sense, selling internally and externally. It was put into place to encourage manufacturing, US manufacturing again, wasn't it?
That's right.
And basically it could be in effect a 9% deduction of your taxable income, which ended up being in effect an effective reduction in your tax rate of 3% when you effect it for taxes.
Right. We called this the old manufacturing deduction. Again, it was applied to producers in the U.S., manufacturers in the U.S. It was a significant deduction of about 9% of the production activities. And like you mentioned, it brought your effective tax rate down. And it was available to everybody, to individuals and corporations. Now that this opportunity is expiring after tax years ending in 12/31/17, and fiscal year taxpayers will have an opportunity to take a portion of this deduction for tax years beginning in 17.
So in reality, what they're saying here is anybody who has an accounting year end that finishes January to November really in 2018 is still eligible for a portion to take a deduction for this or the calculation.
Okay, yes. So while this is expiring, then a new provision has been put in place. And they're calling this the qualified business income deduction. And they're also calling it the new code section 199A. And while it has a lot of things in common with the old, we call it the DPAD deduction, there's some other things that are significantly different. So the first difference is the calculation of the deduction being a 20% deduction of domestic qualified business income. So that sounds like it's a better deal. We're going to watch language on how the domestic detail is documented as regulations come out over the course of the year. This is available only to pass-through entities, which are sole proprietors, partnerships, LLCs, and S corps. The definition in the language of the Act specifically says any taxpayer other than a corporation. So if you are one of those entities, you could be eligible for this deduction. The effective tax rate can be results in a 29.6 tax rate as you take 80% of your highest tax rate and get you down to the 29.6.
So basically from this perspective is if we've got an individual taxpayer that's part of that is a shareholder or a partner in a pass-through entity, is they'll get whatever their marginal rate that they would have paid tax on, in effect is their tax rate becomes 80% of that if they qualify.
Sure. So that's the outline of the deduction. Let's get into more specifics. Specifically, what is, I should say, QBI. What is qualified business income? So that's going to be any pass-through net income amounts that come from your trade or business. This could be your ordinary income. It'll be your expenses related to the trade or business, such as Section 179 deductions or charitable contributions. It will also be gains or losses from sales of assets related to the business, such as your computers or machinery, and you would account for those as you total up your qualified business income. And you also cannot exclude any reasonable compensation or guaranteed payments in this number.
So I suppose that's interesting because obviously, as we were saying, Julie, there's lots of regulations to come out here. And for the people on the call that have S corporations or partnerships, in effect is reasonable compensation for this purpose. We don't know if it's going to be the same as it would be for payroll taxes. So we could, in a sense, have two types of reasonable compensation. And obviously, until the rules and until the regulations come out, we really don't know. We just know the basics of what it's based on. But there are going to be some limitations. I think what about is if you are, my understanding is what are the implications if within your business you're doing business in the US and outside the US, but it all is in the same LLC? Does all that activity going to qualify? Or is the foreign piece going to be dropping out? I
think that's what we're going to have to keep an eye on, especially for our clients, because it does specify domestic activity.
Yeah.
And so we're going to need to learn and watch how they define that, because it's undefined at this point.
So I would agree with you. I think based in this situation, there's going to be situations where we have structures where we maybe have a US company that has an interest or has a division overseas or something. So for US tax purposes, it all comes together on one tax return. But when we do this calculation, we're going to have to split certain pieces out and you won't get the benefit on it.
That's right. So there's a lot to talk about this deduction. There's a lot of people trying to help. We've given you an example of the Limburg Services Analyzers that can kind of walk you through some calculations. I'll advise you there's a fee associated with that, which is new. So they must be getting a lot of hits on their website. But we are providing a few free flow charts to you today to help you kind of walk through the logic of this deduction. Rob's pulling one up now. This is the one I like because it's simple and straightforward, and I think you can easily walk through this. the first question is whether or not you're a service business. We're going to get into a little bit of that more detail later. And then there's an income threshold that we have to watch out for. But this will walk you through how the deduction works. There's a few limitations and exceptions that you have to calculate your deduction if your 20% of your QBI is greater than your 50% of your wages. But I think this is just to get you going in the right direction as you're evaluating your business if you're a pass-through entity.
But I think two big pieces from this flow chart to take are the two boxes at on the top left and the top middle. Is the service business thing is so maybe can you explain a little bit about why, with all the discussion, this service business piece has been so important?
Sure. Well, we were going to get to that in another slide, but jumping ahead, the service businesses have been, certain service businesses have been specifically excluded from the pass-through deduction. And so for a definition of that, if you want, you can read the code section, or I can just tell you that the certain performance fields have been excluded, such as accounting, actuarial services, brokerage services, consulting, health, law, performing arts services. There's two professions that were not excluded, the engineers and architects.
Yeah.
And I'm not sure why those got preferential treatment, but we can just...
Don't call me a cynic, but I imagine there was some money passed. But
so keep that in mind. So service businesses will want to evaluate, which we'll kind of look at those on a case-by-case basis. If you are a service business and you're under this income threshold, you still may be eligible for the deduction.
And that's why the taxable, but the interesting thing with the taxable income here is that in effect is what we've got to make sure we look at here is that is taxable income on the return as a whole. So if we're talking about you've got an S corporation or an LLC that's in a service business or a sole proprietorship, that income will flow onto your personal return. And if that's your only income and you're under, and you're married filing jointly and you're under 315,000, then you'll get the 20% deduction. But if, for example, your spouse is working and they're somewhere else and they earn 200,000 elsewhere, potentially, if you're in a service business, you could lose all that deduction if you go above the limitations.
Right. There's limitations at the individual level when you prepare your 1040, and there's individual or limitations with respect to the wages calculations. And again, this is the first year we're going to see this. We don't have any examples to use at this point that have been tested. There's a lot of speculation going on, and we'll have to continue to watch and advise our clients on how to best apply this to their business. If you think you're going to fall into this pass-through deduction and you want to get into the more nitty-gritty, we're offering you another spreadsheet flow chart that is not as easy to follow, but it does go through the devil in the details here. It will walk through the wage limitations as best as we know now. So we're offering that to you just to kind of keep on file for your future reference. So I think we've moved on to we're trying to get there. We're moving on to the, just a quick and easy example, which Rob sort of addressed. There we go. This is a husband and wife. Husband is a sole proprietor in a non-service business. He has $200,000 of net profit from his pass-through. His spouse earns $50,000 and there's no other income. They're going to take this new standard deduction of $24,000, which we'll all learn that number as we go forward. So their taxable income is $226,000. Their QBI deduction will be, we're going to have to compare the 20% of the net business income of $40,000 and compare that to what their taxable income limitation would be. Their taxable income was $226,000 times the 20% of $45,200. So they get the lesser of the two, of course. And so their pass-through deduction will be $40,000. I believe similar to the old DPAD deduction, this will be presented on the 1040 at the bottom as an adjustment.
Yeah, that's my understanding is when the returns are done for 2018, there'll be a new line item on page 1 that would have what we call qualified business income deduction. You'll do your calculation on a sub-schedule, and then that will be the number that flows through onto your return.
Yep. So that's how the deduction will work. As you saw in the prior slide with the flow chart, there's going to be a lot of more work if your situation is more complicated. And again, we're just trying to keep this simple, high level at this point to make sure you're aware of what's potentially out there for deduction.
Now, I think before we move on to the next section, the question that's come up to us a lot or was discussed when thing happened, there was two things. One, I read and saw certain things that people who've got maybe service businesses, whether they could look at their service business and split it into different sections. And it's called about service business. And as you said in there, it talks about whether it's the person providing the information. Now, they obviously put accounting services out there, but I don't know, but I had thought in my mind is, so could an accounting service, if we said that we weren't providing services, but we were providing a product and the product was tax returns, so no longer are we, in a sense, people buying for a service, they're buying for a tax return, does that now take us outside the service rules? I'm sure it won't under the regulations, but the only reason I bring that up is I think in certain service businesses where you've maybe got different pieces in there, that maybe there is a piece of a product that you do or something, there is talk that people will start trying to separate those businesses out into different entities so they can get it on the one entity, even if they can't get it on the service business. So anybody who's listening who's got what they're thinking is a service business, there might be a possibility if the numbers are big enough to sort of split stuff out, or even try and look at, am I really doing a service, or can I rearrange what I'm doing so I no longer am a service business and I now will qualify for the 20% deduction if I go above the minimum thresholds of, on here you can see once you get to 415 as married filing jointly, or 207, then you phase out. The other question that's come up in a big way is, how should you do business? How should you continue as a C corporation or as a partnership? And I think a lot of people I've spoken to, given the fact that the corporation rate is now at 21%, is when you've got 21% plus sort of potentially 20% on the dividend coming out, you're at 37%. And with the qualified business income, you're at maybe 29. So if you are a pass-through entity in the US, I still think at this stage it most really makes sense to remain as a pass-through entity. For the clients that are on the phone from the UK, in effect, there's a lot less opportunity. Well, there really most is no opportunity really to take the qualified business income deduction because it's a C corporation. Moving on to this, a thing that they changed, and this potentially affects some of our clients, where you're a non-resident corporation or you're a non-resident alien, and you have an interest in a LLC in the US, which would be a partnership for US tax purposes. Prior to this codification within the statute, there was different views to be taken. And the reason being that is, in effect, is that if you sold your interest in a partnership, under US law, a partnership is deemed to be personal property. And if you sell personal property, that's deemed to be the sale of a capital asset. And because the seller of the capital asset was a non-resident, so a UK individual or a UK corporation, under US rules, you didn't pay any tax in the US because it was deemed to be sale of a foreign personal property, so outside the US tax system. But there was also an IRS ruling out there that said that if you sold the interest in a partnership that was an actively trade or business partnership, that because the partnership was doing a trade or business in the US, then you should pay tax on the sale of the partnership interest, because you would have paid tax on it if you just sold the assets of the partnership. So what this law has now said is that basically if you sell an interest in what I would call a working partnership interest or LLC interest in the US, and you are non-resident, then you will pay tax in the US on it. What they're saying, like with a lot of situations where you have withholding tax, where you've got partners or owners who aren't US, is now whenever you sell a partnership interest, you must withhold 10% on the amount realized on the sale, unless the person, who's receiving it is the person who's selling it certifies to the partnership that they're not a non-resident alien or foreign corporation. So it's certainly gone away. I would imagine the IRS was losing money here, so they've certainly made it that whenever you sell a partnership, you're going to have to do 10% withholding on the gross amount unless you can certify that the seller of the partnership is a US resident or foreign or US corporation, and you will be definitely be paying tax on it. Now, what you'll do in this situation, once again, is that obviously you're going to be paying a 10% on the gross amount that's realized, but ultimately that's not going to be your gain. So the UK individual or non-resident individual or foreign corporation will then have to file a US non-resident return, work out what the actual gain is, pay the appropriate tax on that, and then most probably get a refund of a substantial portion of the amount that was paid over. So if we move on to depreciation changes, Julie?
Yes. So depreciation in the fixed asset section, I would say this is where we've seen some simplification. First of all, our Section 179 deduction in the US is pretty much the same idea that the UK has in their annual investment allowance. In the UK, the annual investment allowance is £200,000 for assets placed in service every year. And with this change, the Section 179 deduction in the US has increased up to $1 million. That's quite a significant jump from $500,000. And it only caps out if you invest more than $2.5 million in assets in a given year.
And what we mean by that is so once you go from 2.5 to 3.5 million, that dollar limitation of $1 million gets reduced dollar for dollar until you get to 3.5 million, and then you don't get any Section 179.
Right. So this will begin after for tax years beginning after 2018. Beginning April 2018. The other big news on this front is the qualified real property is now become eligible for immediate write-off. This is significant. It's real estate, favorable treatment for real estate companies. This will allow you to, any non-residential real property, so if your office space needs work, new roof, some heating and ventilation, you could potentially write this off in year one rather than over 31, 39 years. So that is significant. Moving on, the $25,000 write-off for cars has now been going to be adjusted annually for inflation. I think that has been $25,000 for a number of years, so that's good news. You won't have to wait for revisions on that. That'll just become automatic. Bonus depreciation is another way to accelerate deductions. We've been working with bonus depreciation for a number of years. We used to be at a 50% rate. Now they've increased that to 100% rate. So that's favorable as well. This also applies to assets placed in service within 2017. This is one of the only places where you'll see change affecting 2017 returns. So if you put an asset in service at the end of 17 and you're filing your 2017 return, we can apply this new rule this year. The other good news is that it has opened up to include used property, not only limited to new property. So that's favorable as well. One thing to just keep an eye on in this section is that each state may or may not follow suit with these federal changes. In fact, states commonly now don't follow the Section 179 rules and the bonus rules. Certainly, I just did a return this week for California that you're not allowed this same treatment. So you have to keep that in mind as you're looking at your state returns. And the last on the fixed asset updates is in the area of like-kind exchanges. Similar to rollover relief in the UK. In the US, if you buy like property, if you sell property and then in return buy like property, you can roll over the gain into the basis of the new property. They have eliminated the allowance for this exchange on personal property, and it's only available now for real property. So again, that's more favorable treatment for real estate.
The other thing that they've done, which might not affect too many people on the call, is that with respect to interest deduction, if your receipts are 25 million or less, then you can continue to deduct your interest really without any issues. But for the large companies that are more than 25 million in turnover, then you can only deduct 30% of your taxable income. So there is a limitation there. However, any interest that isn't allowed in the current year is carried forward indefinitely. So if for some reason there's a spike in interest one year, then you just carry over the deduction, you take it the next year. It's not lost. So I suppose that's a positive, but we just bring it up in case it has any impact. But it really, for your large companies, it mostly have an impact in years you're making losses and stuff like that. But most probably not too applicable to most people on the call. The other big change that's happened is how net operating losses are calculated, or not calculated, but how they're utilized. Under the old rules, when you had a net operating loss, you used to be able to carry it back 2 years and carry it forward 20. Under the new rules, the losses can't be carried back any longer, but can carry forward indefinitely. The big change here is that where you've got a net operating loss beginning in a year after 2007, so if, for example, you had a loss in 2018 of 200,000, and in 2019 you had a profit of 100,000, under the old rules you'd have been able to offset the loss of 200 against 100 and had a carry forward of 100. Under the new rules, you'll only be able to offset 80% of the 2019 taxable income of 100, which would be 80. And then of the 200, you would have utilized 80, and now you carry forward 120,000 to the following year. So ultimately you'll get, like with the interest deduction, ultimately you will get to deduct it, but the timing of when you can deduct it will maybe be deferred. So what you've got to be careful of, or just remember, is that potentially when you've got losses in earlier years and you've got profits in later years, even though your losses still outstrip your profits on a cumulative basis, you may now end up paying tax in the US. Research and experimental expenses. There's a code section under the current law that basically says that if you've got research and experimental expenses, you can deduct them under various methods. One is you can deduct them immediately. Another is you can deduct them over 60 months. The ability to deduct immediately is going away for tax years beginning after 2021, when then they have to be capitalized and amortized ratably over a 5-year period. The other thing that's interesting is it's a 5-year period, but if you've got research and experimental expenditures that are attributable to foreign research, then those have to be deferred over a longer period of time. The only reason I can think of that is that, obviously, as everybody's aware, is Trump's mantra is "Make America Great Again," and once again is you would be encouraging here from a tax deduction to make sure that you utilize research and development people and supplies in the US, because you'll get a quicker write-off than if you take your research and development offshore.
Okay, next up, we're looking at the entertainment expenses. This probably is one that hits all of our clients. Mm-hmm. So in the past, we were able to deduct 50% of our entertainment expenses, and those can be payments for entertainment, amusement, recreation. Often there include like the cost to buy tickets to sporting events, theaters, concerts. Now the new law eliminates that 50% deduction, so we're at 0% deduction. And also this brings our US tax treatment similar in line with the UK limitations. And accounting methods is another area where I think we're getting some simplification. And the first one is with regard to the cash method of accounting. In the past, taxpayers were limited to using the cash method only if they had no inventory, if their receipts were under a certain threshold of 5 to 10 million. Now they've expanded that threshold up to $25 million and without the test for inventory. So theoretically, if you had inventory and you had receipts up to 25 million, you could elect to be on the cash method of accounting. And that may seem crazy, but it's available now. And I think for our clients' practical purposes, we understand that you can't manage your business using the cash method of accounting. You obviously need to manage your receivables and payables. But if there's something that you might be advantageous to you, given the new tax rates, if you think you can work with your UK parent on different methods of accounting, this is an opportunity that might benefit you. And while you maintain your books on the accrual method, once we get to do your tax return, we can convert the books to cash method and file your return under the cash method. So that's something to consider. They've also applied the $25 million gross receipts test on the inventory uniform capitalization rules, which used to be a little add back that we would have to increase the value of the inventory on the books, reduce your cost of goods sold deduction. This has now also been eliminated, and I think all the accountants are happy about that. Not eliminated.
Yeah. But basically, the UniCap rules were there that when you had stock inventory on your balance sheet, you would mostly have capitalized into their what I call the direct costs. But under these rules, you had to take a portion of your indirect costs or your what we call mixed service costs that relate to various things in the business, and at the end of the year, capitalize those to stock at the end of the year, which would increase your profit. Basically, what they're saying now, unless you what I call a sizable small business, that goes away. So that's going to be easier, and also it means it accelerates the deduction for the clients.
Right. So to do this, we would have to file an election to change your accounting method with your tax return. This will qualify for an automatic election. It wouldn't require the IRS to approve and wait for that approval to move forward.
When you do that adjustment, and you've got obviously an adjustment you've got to pick up, is how does that adjustment get picked up?
So if you're going to move from an accrual basis to a cash basis taxpayer, you would kind of draw a line in the sand, call it the end of your tax year. You would calculate your open receivables, your open payables. You would take the net differential between the sum of those two, and then that would be your true up amount that you could take on your next year's return. Thankfully, there's an election that you can make to spread that income over 4 years to spread out the tax liability if your income would be increasing.
Yeah, so if it's beneficial, so you've got a bigger deduction, you can pick it up in 1 year. But if for some reason you change and the year of change is unfavorable, then you can pick that unfavorable adjustment up over a 4-year period.
Right. Let's see. Next, we've got business tax credits. We just got one quick item we wanted to mention on this front, and that was with regard to a credit for payments to employees who might be taking time under the Family Medical Leave Act. I would say this credit would mostly apply to employers who don't have a short-term disability policy in place in their benefits package. And you might be able to use this if you have an employee who needs to take care of a family member and they're unable to work for a period of time. The FMLA grants employees 12 weeks of unpaid leave, and then their job is to remain when they return. But this credit would allow you a 12.5% credit if you paid that individual while they were gone, just as a goodwill, out of the goodwill for your employee to keep them, with their standard of living. And if you choose to do that, even though you don't have to, there's this credit available. You do have to pay the individual at least 50% of their normal wages to be qualified for this credit. And I think this credit would be in the general business credits, would pass through if you were a S Corp or partnership.
And that 12.5 credit sort of gets ratcheted up, doesn't it? So if you paid 60%, my understanding is you sort of get a 2.5 credit, and it goes up until you get to 100%, doesn't it?
Okay. Yep. The last thing we touched on earlier with regard to compensation is the moving expenses. Unfortunately, the moving expense deduction is no longer available beginning in 2018. If you are sending or deciding whether or not to move an employee to the States or vice versa to the UK, you'll have to include those moving expenses into that person's compensation, so it'll all be taxable.
So I think the issue there is that previously, if it cost $1,000 or £1,000 under US law for somebody to go from the UK to the US, the individual didn't have to pick it up in income, and the company got a deduction for $1,000. If you're paying that now, the individual picks up wages of $1,000, but if you want to make sure they still have $1,000 at the end of the day, you're going to have to pay them maybe $1,400, $1,500, or something like that. So unfortunately, what we're seeing is that I think most employers wouldn't want their employee to be out of pocket when they relocate them, but it's going to be more expensive for the employer now because you're going to have to pay grossed up for the taxes that would be assessed on it, whereas before it was just a business deduction.
Mm-hmm.
So the last topic we'll go on to today, which will take us to about 45 after the hour, is there's been a big change in the international sections of the Internal Revenue Code. Previously, from a US perspective, is if you were a US corporation or a US individual and you had an overseas corporation, you would, as long as you met certain requirements, would only pay tax on that when the profits were repatriated out of the company. And if you were a corporation, when those profits were repatriated out, they would be picked up as income on the US corporate tax return, but then you would work out your tax in the US and get a credit for the taxes you paid overseas, so you weren't double taxed within the corporation. Which was fine, but the fact is what was happening was that the US corporate rate would be maybe for 34%, you'd pay tax overseas at 20%. So the US companies were keeping monies offshore because as soon as they brought them back to the US, they'd have to pay the tax on the differential. So what they've done in the US is they've gone to a territorial taxation system, which is very much like the UK implemented several years ago, that when you bring profits back from overseas that have been fully taxed, then they don't get taxed again when they come back into the country. But at the same time, when you do that, you don't get a credit for foreign taxes paid overseas. The problem here, which we are discussing with one or two clients where it affects them, is these to get to this territorial system, they have basically said that there's a transition period, and during that transition period, which is any tax year or which is in effect going up to December 31st of this year or November 2nd, is any unrepatriated profits at that stage are deemed to be repatriated. So what does that mean? So that means that if you're a US individual or a US corporation with an overseas subsidiary that's got, at the end of the year, in effect, it is earnings and profits, the technical term, but if you look at it as being retained earnings in your overseas company, and it is a controlled foreign corporation, which they are in most of our situations, is that if you've got 100,000 of retained earnings overseas, but you don't want to bring the money back, it is deemed to come back, and it will be deemed to be picked up on your US return, and you will pay 15.5% on that. So that has been an unfortunate situation, because where we've got clients that are in both jurisdictions is you're potentially accelerating tax in the US that you wouldn't have normally have paid until you repatriated it, and you don't want to take the money out in the overseas country because the fact is then you'll pay tax there. So it's a challenge that we're working through, but there's one or two of our clients who are individuals who are taxed in both jurisdictions that we've got to work through, because at the moment it's looking like it can end up being a very detrimental tax effect. So if you are in this situation where you've got an overseas corporation that you've got retained earnings in there, then we need to talk, because the fact is there is a sort of mandatory inclusion on your 2017 return of the retained earnings. Unfortunately, that was a nasty thing that they put in there, and unfortunately there was nothing that anybody could do about it because it was effective before anybody knew what the rule was. So there wasn't any way that you could go back and do something retrospectively. It was effective, which was unfortunate. The only benefit they're giving you is the fact that if you are subject to this repatriation tax, is that you can pay it over an 8-year period, and you'll see that for the first 5 years you do 8%, then 15%, and 20%, and 25%. And in reality, why they're doing this is if you aren't repatriating the money, then they don't want to put you at a complete disadvantage. But if during those years the company's sold or you bring the money back, then you accelerate the payment of the tax liability, which is at 15.5% for cash, and if your retained earnings or your earnings and profits of property, then it's at 8%. That being said, I was going to say we'll take some questions, and there's a couple of questions that have come in. Just pull them up here. The first one would be talking about if I've got an LLC, or would be an LLC that's owned by a corporation is is there still the ability to take the qualified business deduction?
Unfortunately, no. The qualified business deduction is only eligible for individual taxpayers, so it gets trapped and lost there at the C Corp level after the pass-through income comes from the LLC.
So basically is you have to get any benefit from this, you have to be an individual owning the LLC or the sole proprietorship or the S corporation.
That's right.
Okay. The other thing we talked a little bit about, Julie, you'd mentioned was the question had come up is you talked about the depreciation at a state level not being the same necessarily as the federal. Another question that come up was, are there other laws that have come into play with respect to the new Tax Act that are effective for a federal purpose and not effective for a state purpose, which is a good question. We based on what we've read, most things we believe whatever has happened at federal level will happen at a state level. The things when we've had law change like this before is depreciation normally what they call decouples, so it has different rules for state than federal. And the other thing we see is most probably the utilization of net operating losses can be different at a state level than it can be at a federal level. So it's very possible that you could in effect not be able to utilize your NOL completely at a federal level, but you may be able to utilize it completely at a state level. Another thing I just want to talk about that isn't necessarily a question that's come up, but it would be one I want to just mention is that for clients we've got that have to do deferred taxes, then in effect there's going to be a big change this year on in effect is what your deferred tax charge adjustment may be, because when you do deferred taxes you do them at the rate of whatever the effective tax rate is. So for last year most of the deferred tax calculations would have been at 34% to determine what you need to book on the financials. This year it'll go down to 21%. So we're going to see huge swings on sets of financial accounts for deferred tax adjustments because of the rate change. Got a question sort of coming in. So in effect, he's talking about is what's if instead of you want to do some charitable planning, what is the maximum amount that an S corporation can give to a charity? So when you talk about charitable deductions at the S corp level, you can pay whatever you want at the S corporation level, but then you have to go through and the charitable deduction flows through to the individual and then will then get deducted at the individual level based on a limitation on your taxable income and stuff like that. So in reality is when you're planning for charitable deductions, you need to really look at what your personal taxable income will be and what limitations you have there to determine what would be the optimum amount that you pay in. Talking about, there's also in a sense, if entertainment deduction has been limited, what about travel and stuff like that? So nothing's changed with travel. So when your employees are traveling on business, then that is still fully deductible. We'll maybe end it a little early. We haven't got any more questions that have come through. I'm just trying to think if there's anything else that we need to share with you that we haven't. I think we've gone through everything that we feel are the pertinent points. So I think all I want to do is just give you a few takeaways, if nothing else, from today's session. And I think the first thing is that, as you'll see, most of the provisions we've talked about today became effective for the 2018 tax year. So the only benefit of that is that we've got a decent amount of time to plan and work through the new rules. So from everybody listening perspective is, if you've got any questions or you're thinking of doing something, there's still time to get a benefit of what's going on. The other thing is obviously the US has, both from an individual perspective and especially a corporate perspective, has brought the tax rates down to be in line with the rest of the world, specifically to be competitive and to encourage more headquarters to be here in the US as opposed to moving them offshore. As Julie had mentioned, another takeaway from here is we've gone through what we know from a statute perspective, but what's interesting is when there was a major change like this before, my understanding is these, in 1986, when they put together the big changes there, they basically went through and did them over maybe several months or a year or a long period of time. These were put together in 2 months. So we're all in the profession waiting to see that when people really start working through the rules, what technical corrections they're going to be, what the regulations are going to say. So there's still so much unknown at the moment, but we just wanted to give you a flavour of what's changed and what maybe you should be thinking about. And then I think the other big takeaway is that basically for everybody, I think who's on in our client bases on the call today, is that on an ongoing basis, it would appear that any capital expenditures that you do are going to be available for immediate expensing, especially things that we normally have never seen being able to expense in one go, like roofs and structural pieces of buildings, which normally had to be capitalized. But the interesting thing is, I think the planning will come into there is because we can in effect write so much off now, is to sort of work into play that you don't take too much depreciation, that you generate a net operating loss, which is then only available for 80% utilization in the next year. Whereas if we'd looked at it and spread the depreciation out over a longer period of time, you maybe have got down to a better level from a cash flow perspective, not got into a loss situation or just into a loss situation, but then not being profitable in the next year because you couldn't utilize all the loss. So I think there's lots of areas for planning, but it's just to be aware. And like I said, we've got plenty of time. So if you have any questions, please feel free to follow up with whoever is on your account manager, or call Julie or I directly. But with that being said, I think that is everything for today. We'll finish a few minutes early. And we'd like to thank everybody for participating, and hopefully everybody got at least one thing out of today's presentation. So thank you very much, and we will see you next week.